The year 2008 is remembered as a moment when the global financial system came dangerously close to total collapse. It was not a sudden accident, nor a single event, but the result of years of hidden risk, unchecked greed, weak regulation, and blind trust in a system that many believed could never fail. When the crisis finally erupted, it shook the foundations of economies, destroyed trillions of dollars in wealth, and changed the lives of hundreds of millions of people around the world. For a brief and terrifying period, the modern financial system stood on the edge of bankruptcy. The roots of the 2008 financial crisis can be traced back to the housing boom in the United States. In the early 2000s, low interest rates and easy access to credit encouraged people to buy homes at an unprecedented rate. Banks and mortgage lenders began issuing loans to almost anyone, including borrowers with poor credit histories and unstable incomes. These risky loans became known as subprime mortgages. The belief was simple and dangerously flawed. Housing prices would continue to rise forever, and even if borrowers failed to repay, the value of the homes would cover the losses. Financial institutions did not stop at issuing risky loans. They packaged thousands of mortgages together into complex financial products called mortgage-backed securities. These products were then sold to investors around the world, including banks, pension funds, insurance companies, and governments. To make these securities appear safe, credit rating agencies assigned them high ratings, often equivalent to government bonds. Investors trusted these ratings and bought the products in massive quantities, believing they were low risk and highly profitable. As demand for these securities grew, lenders lowered their standards even further. Loans were issued with no income verification, no down payments, and adjustable interest rates that would rise sharply after a few years. Many borrowers did not fully understand the terms of their loans. They were told they could refinance later or sell their homes at a higher price. The entire system was built on confidence rather than caution. By 2006 and 2007, cracks began to appear. Housing prices stopped rising and began to fall in many parts of the United States. As prices declined, borrowers found themselves owing more on their mortgages than their homes were worth. Defaults increased rapidly. When borrowers stopped making payments, the cash flow supporting mortgage-backed securities dried up. Suddenly, financial products once considered safe became deeply uncertain. The problem quickly spread beyond the housing market. Banks and financial institutions around the world held these toxic assets on their balance sheets. Because the securities were complex and poorly understood, no one knew their true value. Trust between financial institutions collapsed. Banks stopped lending to each other, fearing that the next institution might fail. This freeze in credit threatened the basic functioning of the global economy. In September 2008, the crisis reached its most dramatic moment. Lehman Brothers, one of the oldest and most respected investment banks in the United States, declared bankruptcy. Its collapse sent shockwaves through global markets. Stock markets plunged, credit markets froze, and panic spread across the financial world. The failure of Lehman Brothers was not just the fall of a single company. It was a signal that no institution was truly safe. Following Lehman's collapse, fear dominated decision-making. Investors rushed to withdraw money. Companies struggled to access credit. International trade slowed as banks refused to finance shipments. Governments realized that the failure of major financial institutions could trigger a chain reaction leading to a complete economic breakdown. The world stood at the edge of a financial abyss. In response, governments and central banks took extraordinary measures. The United States government launched massive bailout programs to rescue banks, insurance companies, and auto manufacturers. The Federal Reserve injected trillions of dollars into the financial system to restore liquidity. Interest rates were cut to near zero. Similar actions were taken by governments and central banks in Europe, Asia, and other regions. These interventions were controversial. Many people questioned why taxpayers were forced to save institutions whose risky behavior caused the crisis. While banks were rescued, millions of ordinary citizens lost their jobs, homes, and savings. The unemployment rate soared, foreclosures spread across neighborhoods, entire communities were devastated. The crisis exposed deep inequalities within the economic system. The impact of the 2008 crisis was global. European banks faced severe losses, leading to sovereign debt crises in countries such as Greece, Spain, and Ireland. Emerging markets experienced capital outflows and economic slowdowns. International trade contracted sharply. For the first time since the Great Depression, the world economy entered a synchronized recession. Beyond the economic damage, the crisis caused a profound loss of trust. Faith in financial institutions, regulators, and governments declined. People began to question the fairness and stability of the system. Movements calling for reform, accountability, and transparency gained momentum. The crisis reshaped political landscapes and influenced policies for years to come. In the aftermath, new regulations were introduced to prevent a similar disaster. Banks were required to hold more capital. Risk management standards were strengthened. Oversight of financial markets increased. However, critics argue that these reforms did not address the core issues. Financial institutions remain powerful. Complex products still exist. The system remains vulnerable to new forms of risk. The 2008 crisis revealed a fundamental truth about modern finance. When financial systems grow too complex and disconnected from real economic activity, they become fragile. When profit is prioritized over responsibility, instability follows. The crisis was not caused by a single mistake, but by a culture that rewarded short-term gains and ignored long-term consequences. For a brief moment in 2008, the world came close to a complete financial collapse. Cash machines were at risk. Businesses faced shutdown. Governments feared social unrest. It was a reminder that money, despite its digital nature, is built on trust. When trust disappears, the system collapses rapidly. The legacy of the 2008 crisis continues to shape the world today. It changed how governments respond to economic shocks. It influenced debates about inequality and corporate power. It reminded humanity that financial empires are not invincible. They can fall, and when they do, the consequences reach far beyond trading floors and balance sheets. The day the world almost went bankrupt was not just a financial event. It was a historical warning. It showed how interconnected the global system had become and how quickly failure could spread. It taught painful lessons about risk, responsibility, and the cost of ignoring reality. Understanding the 2008 financial crisis is essential to understanding the modern world. It explains why markets are fragile, why trust matters, and why economic power must be handled with care. The crisis may be part of history, but its lessons remain unfinished. The question that remains is not whether another crisis will come, but whether the world will be prepared when it does.